Let's take us through what the expectations are for today. We know it's not a rate change, but we get a lot more data and context and color from the Fed and its policymakers, right?
Right. It's going to be a weird meeting for them because they're getting a really important inflation number, our sort of final read for the year of what is happening with the consumer price index today. And then they have to make this decision tomorrow. So we're very much still expecting them to hold rates steady kind of no matter what happens. But this inflation number could really matter quite a bit for how they're looking at the future and what they're telling us about what they expect next year.
Speaking of the future, the summary of economic projections, the Fed always gets scrutinized for these forecasts that they're asked to make on an anonymous basis. What exactly has been the trend over the last several months here, quarters, with regard to these so-called dot plots? And what exactly do they tell us about what we think could happen in 2024?
So I think the really important thing to know is that as of the last dot plot, the Fed is still expected to make one more rate increase this year. We're not expecting that, obviously. And then they had expected to lower rates a couple of times next year. The big question is, how much lower they are expecting rates to be by the end of 2024 relative to where they are now. I think there's sort of a range of estimates around what that might be. And then obviously that is going to be an end of year prediction. That's how these estimates work. They predict where things will be in the fourth quarter. And so it's not going to give us a lot of hint about when those rate cuts, assuming there are some predicted, when those cuts might come. And so I think for that, we're going to be really closely watching Jerome Powell and his press conference, which comes after the release of both the statement and the SEP at 2 p.m.
Jeanna, the idea is that inflation has to be at least less of an issue in order for the Fed to do anything different than it already has. It's already paused a few times with regard to its rate hiking campaign. What does inflation need to show? How dramatically does inflation need to slow down in order for the Fed to feel as though it can actually do something different than what it has been over the course of the past year plus?
Yeah, I think that's a really interesting question at this stage that we don't have a super precise answer to. They're very clearly happy with the trend that we've been seeing. And they're very clear that they don't absolutely need to see inflation completely crushed. They need to believe that it's on track to be back at their goal. And so I think that, what we are hearing from some Fed officials, what they've said publicly, is that you would want to see a little bit more progress. You'd want to see more progress like what we've seen. Chris Waller threw out a range of, several months of more progress. Like what we've seen before you would feel comfortable cutting those interest rates. And so I think a lot of people have taken that to mean certainly not January, but that it's not impossible that we could get a rate cut in the first quarter. And that is why I think you're seeing that market implied pricing that says you could get potentially a rate cut as soon as March, although markets see May as the more likely candidate at this stage.
We've been focused so intently on inflation, and rightfully so, because it's been such a huge problem over the course of the last couple of years. We haven't talked as much about or framed the discussion as much about the economic growth picture. What would happen with the economic growth story if we started to see certain, at least, signs of weakness in the U.S. economy? Maybe not an outright huge recession, but certainly a bigger slowdown than Fed policymakers would be expecting.
So when you talk to economists about this actually is probably the easiest possible scenario for the Fed, because if they saw a big slowdown in economic data and it came simultaneous with a big cooldown in inflation, the prescription for that's fairly easy from a policymaker's perspective. You cut interest rates. You've got interest rates at a pretty high level now. They're weighing on the economy. If momentum is cooling at the same time that inflation is slowing, that's a good suggestion that you should have lower interest rates. And so that may be the easiest scenario for the Fed. It's, obviously just one of an array of outcomes that we could experience in 2024.